Hello to everyone. I'm hoping you're all fine and ready to and excited to start the course of financial reporting today with me. Although we have met the last week, but the last course, you can remember it was an introductory course. It was an orientation-based course. We could not start the course the last week, but yeah, lots of useful information, lots of important talks we have had, which you as a student of financial reporting and a distance learning course student has to keep in mind. I have been able to introduce the financial reporting course also, the course contents, the exam pattern, and lots of things that let's just wait for 1 minute. I have to help someone not listening to me, so probably wait. You have to join from computer audio. I guess one of the student has got this issue in, or two of them. Is it fine? The rest of you, they can listen to me and write into a chat box. Yeah, so it was fine from my side, but from the side of a student. Happens, no problem. I'm there to help you in the start of the course. And yeah, like I said, this thing may exist for a session or two. After that will be fine. Once again, I can remind you of that. You see, I do these things every day. This is my everyday task, conducting the courses all day long, sometime on weekends, full day sessions, and in weekdays in the evenings. So from my side, the things are always tested and tried. And because that's what I do every day. That's not the case with you people. So when you join into a Zoom session, and now whatever you have experienced it, try not to forget that process of getting into the course so that it will not be an inconvenient to you also and for me also, taking a time of a course and helping the students out. Although I don't mind helping it, but I mean, to start the course every time with these sorts of help and wasting some time, not for the good for the health of this course. Even it disturbs me. I have to keep on feeling for those they cannot get into a session or they're hardly are struggling to listen to me. So I have to help them up, but on the other side, the live course isn't running. So it's difficult at time for me to even stop the live session and help those out. Something that you have to keep in mind. I guess today no one has found an issue in joining in the session because you people all have experiences the last week. One or two students, they have complained with the voice that they cannot listen to, which was the issue of their own side, that they had to join it from computer audio. Because like I said, I do these things every day. So for my side, my setup is always ready that the next minute I have to take a course, I just sit in and start the course. It's like that. It's a studio. It's not a home setup that I have to, first of all, have to make it. It's always set, powered on, and any random time I have to take a course, I can just start it the very next moment by starting the meeting. Anyways, the last week we people have met. We have done lots of good things. Not we have started the course, but we have done many talks, which is very important at the start of the course for a student of financial reporting and a distance learning student has to be aware of, within which I have been able to bring in a lot of detailed talk in regards to the exam pattern of FR, the course progression plan, the course contents, and how we will take this course to the next 4 months. Before than that, I came to also help you, brief you on joining the meeting from the portal and how to gain an access to the resources on portal time after time. Then I came to also help you on with the computer-based exams environment. Lots of guidelines I had shared in the last 30 minutes of the course. So it was a whole of a 3-hour session, which has exhausted all of a time. If anyone has joined me in between, you are advised to take a time out of your busy life and watch the recording of first session, because that recording will set up the tone for you for the next 4 months. Everyone was there. Most of you were there, maybe 1 or 2, or let's say 3 of you, they have joined me in between. They must have to take a time out of their busy life to watch the recording of our oriented session. So with this, let's connect ourselves to the board to finally start the course of financial reporting today. I don't think anyone's still on the WhatsApp asking me for my help. Let me just check it for the one last time so that so hearing the issue I already have resolved from one of the student. Okay, so no issue. Fine. So I will come to respond all of those messages. Those are other than in relation to not being able to join the session and all. This is something that you have to keep in mind when I'm into a live session, so I cannot be responsive to any other talks other than if you are finding it difficult to get into the session. This is the case where I still can be thinking of helping you out by so we are connected to the board. We are on chapter 5. The last time when I was talking about the exam progression plan, the course progression plan, I did give you the whole guidance of which chapter I will be starting off and the reason of that why. So I'm not getting into that talk today. Rather, I've landed myself onto chapter 5 and we are making a start of the course of today. This chapter 5 is titled as non-current assets, tangible non-current assets. And this chapter takes 4 related reporting standards. As you can see, the top of the page, the top page of this chapter shows that there are 4 standards: I-16 on property, plant, and equipment, I-23 on the borrowing cost, IAS-20 on the government grants, and IAS-40 on investment property. These 4 standards are all to be prepared like a pack of tangible non-current assets, because all of these 4 are interrelated. They are related to each. These 3 standards are entirely the newish ones. Never in the life you people have ever studied. While this one, you have an idea, is going to be a revision-based topic, as you people have done this property, plant, and equipment in your previous studies also. The chapter within which you people have learned in the past, the depreciation, the valuation, the disposals of the assets, and the accounting stuff in relation to the recording of property, plant, and equipment. So something we will come to look into it in the first place before taking ourselves down to IAS 23, 40 and IAS 20. Now, IAS 16, the summary of that, I have been able to bring it along, and the board work. Now, today you will get the better taste of that, okay, how the course is actually delivered, that what we will be doing from the detailed lecture notes, and how will I be going to attach these detailed lecture notes with the summary, and what sort of stuff on the board explanation you are expecting to see. Today you are going to get to know the whole thing that the last time, obviously, you had not experienced it, since we haven't started off with any topic, the discussion of any topic the last week. Why are we taking a start from I-16? Because of 3 reasons. Number one, even if this standard is a revision based, I even have said this to you before starting that this standard is a revision based. The standard is a revision based. Then why we are going to take this on a very serious note? Because first reason, the way the property, plant and equipment standard is tested at this level is different from the way this standard used to be tested in the past. So you will have to prepare this topic the way this course requires it to be prepared. Even if you have a knowledge of it from your prior studies, still this standard will be learned by making an assumption as if it is a new topic and we will have to get into the depth of every little thing. I will take that assumption that you people have never done this topic in the past and requires to have all the detailed talk. And you at your side also have to keep this thing out of your mind that, okay, you have done this topic in the past, so you can be casual at it. Because I'm telling you, the way that this topic needs to be learned at this level is different from the way that this used to be tested in the basic courses. Second reason, that why is it too much important to start the course with IAS 16? Second reason, whatever we will go to learn in IAS 16 will set up the base for the next many topics to come. And you will feel it, you will taste it, you will realize it by yourself. Right now, I'm telling you, you still may not pay attention to what I'm saying right now, but you will experience it as this course will go forward into the next session, second next session, third session. You will remember my words. All the knowledge which we will come to learn will set up the base for many next standards to come, not in this chapter, even in many next chapters. So it's like a gateway to many next reporting standards. So if you cannot find the gate, or if you cannot enter the gate, you will never be able to access the rest. It's like a tunnel, and you have to enter into a tunnel. So you cannot enter into a tunnel midway. You will definitely have to have that one entry point. So this is that entry point. So by taking these some examples, I'm trying to let you know the importance of this topic, so that when I will take this into my discussion and explanation, your attention will fully be there. And this standard is too big that we will not be able to finish that off today. So let's finally start ourselves with the topic named IAS 16, property, plant and equipment. So what's been written there back into lecture notes, I will come to reveal all of that in a while. IAS 16, the standard. We're starting off with the title of which is property, plant and equipment. Now, if you look back onto that summary, the summary makes the whole of that task so easier. Just give me 1 second. Okay. Summary makes the whole of that task a lot simpler. You see, at the end of the day, when you have to keep 20 odd list of standards in your mind, the summary is going to be a blessing. Although you cannot just rely on that summary to pass your exam all alone. You definitely have to have your detailed course explanation, whiteboard explanation, and the detailed notes and practices from the practice banks. All alone, you cannot just pass your exam by preparing yourself only on summaries, but this will be a value addition, a supplement, which will be attached to your major explanation just to make the whole task easier. When you're done with the preparation of one topic in detail, you will find that summary so easy to keep that into your mind, the whole of the topic. So it will act like this. But just rely onto that summary and expecting that you will be able to prepare your course, this is not going to happen. Every document has its own place, has its own respect. You cannot just substitute the lecture notes with the summaries, or you cannot just say that, okay, I'm done with the lecture notes detailed, so I do not need to look down into the summaries. Every document has got its own place and you will have to respect it. Starting ourselves off with the definition of property, plant, and equipment. It's written in such a easy, friendlier manner that without even I have to say a word, you can read it through and can understand. Because each word has been separately been defined, means the whole of that definition been divided into number of parts, and each part has been defined. Then lots of examples being put forward. Based on to that, you can understand, okay, what is the property, plant, and equipment. So if I go to now really expand my explanation to words, the first thing that you probably have seen on the start is the word non-current asset. The meaning of that word is pretty much easy to digest. Benefit more than 1 year is called as non-current. If an asset provides the benefit for more than a year, it's called as non-current. Can be 5, 10, 20, 30 years. But if it is more than one, non-current. So easy to digest and remember. The word tangible, the dictionary meaning of this word is known to you. Anything that can be seen, that can be touched. Fine. The word asset, we know that generally, but the way that it has been defined in conceptual framework is this way. A resource that has been controlled by an entity from which the future economic benefits are likely to flow towards enterprise. The word control in the definition of asset is too important. The word control means you have the possession over to it. Physical occupation. And by having a physical occupation over to it, by having a possession over to it, it's being controlled. And because of that control, you can guarantee those benefits coming to your way in the future. Anything that you cannot have a control over to, the benefits in the future, you cannot guarantee it from because you do not have a control over to it. But what is in the control of, you can guarantee those benefits coming to your way in the future from that. I can give you lots of examples to really justify this. If I give you a very simple example out of my setup, the studio, lots of electronic equipments are being there around, the iPad, the laptop, the microphone, the lighting facilities, and plenty of appliances that obviously is not visible to you from that part of the screen. They are all controlled by me. I'm the owner of, and not just the owner of, I am having a possession over to. They are in possession of. I'm using them up and getting the benefits out from by having a possession over to. And it's me who gets the benefit out of these, no one else. Because no one can access this without my permission. It's always secured, locked. The studio is always locked. And I only will have an access to the studio. And then once I'm accessible to this, I get the benefit out of these, no one else. So I can call all of these gadgets to be the assets of mine because I am controlling such. And by having a control over to, the future economic benefits will continuously to flow towards the business. As in the past it has been, it will even be in future. And not just for 1 year, definitely will be for, like if you take an example of a laptop, the life of the computer, the laptop can run for 4 to 5 years. If you by yourself do not throw it away because the new model has come in, so you will have to buy the new one and let's throw this old one out. If you do not do this by yourself, the same laptop can be used for 4 to 5 years easily for everyday computing. So this laptop is something that I can see it. It's tangible. It can be seen. It can be touched. Provides me for the benefit for more than a year, 5-year life. It's something that I'm having a control over to it by having a possession. And because of that, I can guarantee those benefits coming to my way in future. Benefits in what way? By doing all of my administrative tasks, running my courses, and all those tasks which I am still performing it by using this device is the benefit that I'm taking it out of this machine. And why did I keep this laptop with me? What has been the intent behind? Use. Am I intending to sell this laptop to someone? No, it's been intended to be used into my business to provide the benefit of service. So this laptop to me is a property, plant, and equipment because it takes all the 4 parts of the definition within it. Then depending upon the type of asset, each asset has got its own use. For example, the machine is held for what purpose? Production purpose. The motor cars are kept for what reason? Delivering the goods, or sometimes you provide pick and drop service to staff. Factory, building. The buildings are used for what reason? To construct your factories into it, warehouses into it, marketing office into it, retail premises into it. So depending upon the type of asset, then the uses could be of any other type. But point is that all of these examples being put forward, they have got this intention of using, not selling. So that completes the definition of property, plant, and equipment. The office fixtures will take generally everything, the lightings, the air cons, and all those appliances, office fixtures, tables, chairs, furnishings. All of these things are called as office fixtures. So they are held for what reason? Administration. They're not been held with the idea of selling. They provide the administrative benefit to the business. Factory building provides the benefit in a shape of factory, in a shape of warehouse, in a shape of accounts office, in a shape of retail premises. While the motor car could be used for either delivering the goods or providing a pick and drop service to staff, or even that motor car can be used by a staff to perform their all those the sales staff usually uses the car to go on to places and to visit the clients and meet those. So, I mean, that is the use of car, and the machines are held for what reason? To have a production over to it. Point is that all of these assets, they are held in the business to provide the benefit of service. And each of the example that you see down below takes all the three parts in it. They can be seen, they can be touched. Benefit definitely for more than a year. And they are being controlled by a company. Same like machine is being installed in a factory. And that machine is being controlled by the owner of that factory by having a physical possession over to. The factory can only be used based on whatever the limits been assigned during the specific hours by not all of the staff member, even by some specific staff. So to get into that machine, the password needs to be entered. So there are few personnel who are authorized to actually start off that machine, else no one else. So what does that suggest? That it's controlled. Similarly, that car is to be driven by that one specific person. No one can access that car without the permission of that person. All of these examples you have to keep into your mind, which will justify the whole of the definition of property, plant, and equipment. And you can take any example around you and try to pass through that example to 4 of these parts. You will definitely call up them to be as property, plant, and equipment. Take an example of the cell phone that you have. Although the cell phone is not a business asset, I'm talking about from the perspective of your personal gadgets. So the cell phone that you have, whatever the cell phone that you use, I'm sure you have a cell phone. Who does not have these days? Maybe some people have 2-3 cell phones at one time. That cell phone is something that can be seen, that can be touched. Fine, it's tangible. Secondly, the benefit of that cell phone is definitely more than 1 year. 5 years, non-current. Thirdly, it's something that you have a full control over to it. Now you can better understand the meaning of that word control. Your cell phone is something that's been fully controlled by. It's password protected. No one can enter into your cell phone without entering that password. It's you who will have an access to it. And you are the one getting the benefits out of it by making the calls and by doing whatever the other stuff you do it by using your cell phones, the platforms that you have joined it in, or some whatever the works that you perform on. It's you who's getting the benefit out of that handset. And ultimately, why did you buy that the cell phone? Not with the idea of selling it tomorrow, with the idea of using it. So with that use, the benefits are extracted, not by selling it. So when all the 4 parts of the definition are being checked in, the cell phone of yours will be called as an asset of yours. And generally we call it, yeah, this is my asset. My cell phone is my asset. So ultimately, you have to apply these 4 parts of the definition before deciding to call it as property, plant, and equipment or not. Try to adapt this way as from today. Generally, anyone can say anything. Try to be according to the way that the standards they require us to learn these things. Okay, I guess no further time I need to spend on to something that is already quite much understandable to all of you, but still I'm giving my 101% onto it. So tangible, non-current asset held in the business with the idea of using completes the definition of property, plant, and equipment. Just can give you one more example to wrap this talk up. The aircon that's been installed into my studio, the aircon, it's something that I can see it. It's something that I can touch it. It's tangible. The life of the aircon, at least 5 years, non-current. It's controlled by me. It's been installed, fixed onto that wall, and I have the remote into my hand, only to be accessed by me. And ultimately, who's getting the benefit out of that? Me, myself. So the benefits from that aircon in the future are guaranteed by having a control over to it. And lastly, why did I keep that the aircon for? Use. I'm using it, not selling it and recovering the benefit out of that. Rather, it provides me with the benefit of service. So that aircon will be a property, plant, and equipment of my business. Good with that? So a lot of examples you can just hypothetically bring it into your mind and try to pass them through to these 4 parts. And you will be in a position to really say that, yeah, this is property, plant, and equipment, and this is not. How to measure them initially and subsequently. This first page gives us the overview. And the next pages will take all the detailed talk. As you can see on the next page, there is a detailed talk in regards to cost. Then there's going to be a detailed talk in regards to a property, plant, and equipment. The depreciation, detailed talk. Then there's going to be a detailed talk in regards to valuations. So all will come to our way. This first page just gives us the overview. So they say that initially, the word initially, when I say, I mean to say on the date of acquisition, on the date of acquisition, and subsequent, when I say, I mean to say reporting date. So these words will keep on coming to your way. Initial, recognition, subsequent. So the word subsequent means reporting date, most commonly. Subsequently, you can have certain other transactions like valuations, like disposals, but usually the subsequent, the word is used in the context of reporting date value. And initial, obviously, the word suggests first time when you have acquired it, purchased it, constructed it. Cost initially, subsequently, either you continue with cost or you have an option to switch it to a valuation. Either of the two, it's going to be a choice of the entity to go by keeping it at its cost or the reevaluate amount. The big difference in the two is there, the asset is kept always at its historic value. Historic value. History does not change. Historic value does not change. Whatever the value at which it was being acquired 10 years ago, you come to keep your asset at the same value forever. Whereas, in contrast to it, the revalued amount, revaluation model is a model where the asset is kept at its market value. And whatever the change the market has brought in year after year, you keep on bringing it in by updating, because market value keeps on changing year after year. So whatever the change in the market value has been seen year after year, you try to incorporate the same into books when you follow a valuation model. Whereas the cost model keeps on taking the history into the books. Okay with that? So we will come to look into these two models in depth on the next page. But from that first page, you have to keep in mind, okay, initially at cost. Subsequently, we can continue with cost if it is feasible, or we may switch it to a model of valuation within which the asset is rather kept at its fair value or market value. Even if I go and look into the contents of this model, cost comes first. The depreciation comes on the next. And both of these talks are coming to our way, so have a bit of a patience. But this third thing that you can see over here, the impairment loss, we will come to look into it later on. Being a part of chapter number 7, we will learn it. So when I go to refer something, I always give the students the reference, the guidance. Okay, we will come to learn this in this topic, in this chapter. The impairment loss is just another topic, and that cannot be taken into discussion in this chapter, even in this standard. As you do not even see, we will come to learn IS 36, not even being the part of this chapter. Let me try to reload the file. It's getting little stuck. Okay, so you do not even see it's being there in the chapter 5, because I have told you we will come to learn this in chapter number 7. So it is because one of the content of these models, so I have been able to write it, but we will not go to cover it, being the part of I-16 or chapter 5. We will come to learn it probably in our 4th course, when we will be on chapter 7, IAS 36. But the rest, for surely, we will come to learn today in some time. So that's the first page. Mainly the definition of property, plant, and equipment, and you have been able to quickly know that, okay, how to initially measure and subsequently, initially at cost, subsequently either at cost or a revalued amount. The difference of the cost model to the valuation is pretty obvious. In the cost model, we keep the asset always at its historic value, whereas in the revaluation model, the asset is valued. To bring that market value into each year, we have to carry out a process of valuation, which is what we call it as valuation. On top of that, the definition has properly been talked about. I don't think the need is there even to look back once. Tangible, non-current asset held in the business with the idea of using completes the definition of property, plant, and equipment. Each word should be known by its meaning: tangible, non-current asset held in the business for use, and then try to pass through any hypothetical example that is around you, so that you will start getting to know the way that one has to label this is as property, plant, and equipment, and this not as property, plant, and equipment. See, if you are holding such assets with the idea of selling, that will be an inventory to you. If you are a car dealer, this time the car to you is not a property, plant, and equipment, rather an inventory, because there the car, although is tangible, but you're not holding it with the idea of using it for yourself, rather you're holding it with the idea of selling. So that car, which was once being classified as property, plant, and equipment, now will be classified as what to you? Inventory, goods held for sale. Same way, if the aircon that I was giving you an example of, if you're into the electronics business, and the electronics will cover lots of appliances, but if I take the example of just the aircon, it's saleable item, which has been displayed in the showroom. So the aircon this time will not be an asset, rather an inventory to you, because you're holding it with the idea of selling, because that's what this business is about. This is your saleable item. Good. This is where the thin line difference comes in, which you must have to respect, that what has been the intent behind. The intention behind is to use that for yourself, that it is a property, plant, and equipment. But if the intention is to sell it, becomes an inventory. For inventory, we know that we have another topic, IS2. You people have definitely done that in the past, the topic of inventories. So let's take ourselves into the discussion of someone is still not been able to join the class, I've randomly checked. If that person is still not in the course, just bear with me. I'm going to help her out joining in the session. And the issue, I do not know. The issue is what? The green button to join the class is not active. How can that happen, that the green button is not active? So what sort of help I can do that? Because I'm not even a technical guy. It is supposed to be a green button, should be working there during the class hours as you people have joined it in. So probably I can ask that person to restart the system, change the browser or something like that. That's the best I can do. I cannot do anything other than that. Should not happen. Maybe a problem with the browser that she's trying to log in from. So see, this is something that obviously I also have a limitation. I'm not a tech guy or IT guy that can actually look into these things. It's a company that I have taken a service from, and I also had taken a bit of a time to get used to with this portal. But once I'm fine with this, I use it now every day, and you people also have been using it now from the past 2 weeks. So if it an issue for all of you, then it's fine. But if one of the person is facing an issue and we are in the course taking a session by joining in, then it clearly suggests the problem lies somewhere in the system of that student. May needs to restart the system, may needs to reinstall the Windows or Macintosh, may have to change the browser or try to log in the same thing from the cell phone to really check if the person can join it or not. It's called a troubleshooting. Even if you will be able to miss the course of today, not a big problem because you will be able to catch it up from the recording. At least the issue will be addressed by changing the device or changing the browser or restarting the system. At least you will get to know that okay, it's working. The problem was there with my earlier browser or something. It will be troubleshooted. And then join the course for half of an hour, maybe 1 hour, whenever you'll be able to, and then try to catch it up from the recording. It is a one-off thing. The next time you will be fine with that. So if this happens to you next time, try to keep into your mind. Just try different possibilities. That's the only thing I can suggest that to you also. Because the way to come into the class is that one way. Log into your portal by using your credentials and join the class. This is that way you as a student have to use it. This is the way that I even use it. Other than that, I do not know if that person is not been able to join the class because the button is not green or enabled. I can't help it. That person has to just try different things. As I'm telling you, may have to restart the system, or may change the browser, or just go and change the device entirely to at least see that it's now joined in, so that the trouble once will be shooted. Learn that now from the next week and on, rather to keep on asking me, because I don't have a solution to that. If that happens again, someone, I will just say to that person, try different things to at least log in. Okay, let's get into a detailed talk of cost. The discussion of cost is now this base takes the detail of cost, and even I've been able to divide the discussion of the cost in two parts: initial cost, subsequent cost. The word initial means the cost that has been incurred for the first time to make an asset serviceable. You bring that asset into a serviceable state. You bring that asset into a usable state. All the cost that is incurred on the way to make your asset serviceable for the first time is called as initial cost. The first thing that comes to mind when we say cost is purchase price, which is good because purchase price is the first thing that comes to the mind when we say cost. If I'm going to buy an asset from someone, let's say a motor car, so I will pay a price. That price will become what? A cost to me in buying a car. So the first thing is the price. But it's not just the price. There are many components which will join into a purchase price, and that is what we are going to talk about the next 15 to 20 minutes. So yeah, it starts off with price, undoubtedly, whatever the price that's been paid. But then we will come to take many things. You have to keep into your mind, buying an asset is not just one task. You do an asset will be used in the next minute. You may have to incur lots of cost to make that asset serviceable for the first time. Let's try to make things easier by taking one good example. Imagine you are purchasing a plant from abroad. So that person has finally joined in. I can see, yes. See? So probably have learned the lesson from that student and rest of you also. That the system does not have an issue. If the system will have an issue, you will not even see me coming into a live session. If anything happens to you, just to you and not to the rest, clearly clarifies that you have the issue somewhere in your system, in your Windows, in your browser, in your device. Try and make the possibilities of different things to get into the course, not a big issue. Rather to keep on writing me and ultimately not joining the class. I have just did not do anything, just help the lady with that. Again, by telling her, okay, try and get into the course by making different tries, this and this, and she's in now. So something that will remember by you and all. So getting back into a talk of cost, all the cost that has been incurred for the first time in making that asset usable, serviceable for the first time is called as initial cost. And it's not just the purchase price. Imagine you're buying a plant from abroad. It's an imported plant. So you will have to pay a price. That is the first thing. Your price may have been reduced by the effect of discount. Now there are two types of discount: trade discount and settlement discount. Trade discount immediately reduces the price instantly. The day you came to acquire, there was a 10% discount. There was a promo. And your price has been reduced by 10% and you have ended up paying 90%. So that is trade discount. Your price will immediately be reduced down by 10%. So that is called as trade discount. Price less trade discount. Exactly, that is what I have been able to write, that the first thing. Purchase price less trade discount. But this is where you have to understand that there are some other types of discounts. Settlement discount, and we will have to clearly ignore this. This is also called as cash discount. And this is that type of discount that you have to ignore. And I can tell you the reason why, not just to ignore. First of all, what is cash discount? What is settlement discount? Settlement discount is for early or prompt payment. If your supplier has given you 60 days to pay a credit period, 60 days, and on top of that, the supplier has offered you that, okay, if you pay the same amount in 15 days, I will give you 20% discount. So this offer is an offer of settlement discount. Usually 60 days credit term, but if you pay the same amount in 15 next days, I will give you 20% discount. So that is called as settlement discount, cash discount, or early payment discount. Now it is an offer which the customer might avail, might not avail. It's not like a trade discount, which effectively brings the price down instantly and you've ended up paying less. Rather, it is an offer. You might be accepting that offer, you might not be. It gets confirmed several days after, on the date of settlement, not on the date of purchasing an asset. So that's the reason why we will never come to include the settlement discount thing while computing the cost, because the confirmation of that discount is certain number of days after, on the date of settlement, not on the date of buying an asset. So if the discount is availed later on, it will be treated, but it will be treated somewhere else, not while computing the cost. So where will it be treated? I will come to explain that to you also in a while. But at least while computing the initial cost, settlement discount will never be used, even if the question says it has been availed. I'm telling you loud and clear, even if the question says that the settlement discount has been availed, do not make the use of that while computing the initial cost. Just ignore it. It will be treated elsewhere. And that I will come to show to all of you in some time. So price less trade discount. Why? Because trade discount immediately reduces the price down by 10, 5, 20, whatever percent. It's as if you go to a market to buy any clothing item and there was a promo Black Friday sale or whatever sale is going on. So whoever comes to buy an item in that market, the price reduces by 10%, 20%. It's not, first of all, available to certain customers. It's not like an offer that you might have to avail, you might not have to. Whoever will come to buy on that day that item will end up paying less price. It's a trade policy. So it's called as trade discount. But settlement discount is a type of discount which, first of all, the supplier may not offer to everyone. Might have been kept for some more trustworthy customers, long-standing customers. And then to some customers, the ratio of discount is 10%. To some customers, it's 20%. To certain customers, it's 30%. So it's like an offer which can vary from customer to customer, or which may not be given to all the customers. And then even that customer might have to avail, might not have to avail. So coming back to the point, even if the question says that the settlement discount has been availed, it's just there to confuse you. Do not consider it while computing the cost of an asset. Next, because this plant has been purchased from abroad, so it has to arrive to your country either by an air or by shipping. So you will be asked to pay these sort of charges, air freight or shipping charges, which will be a cost in addition to a price. If you will not incur the cost of shipping, it will never be shipped. So how will you be able to make that asset serviceable one day if you are unable to ship that to your country? Because the cost is not incurred. So the shipping cost is an additional cost on top of cost of purchase, which one has to add it in. So keep that definition in the mind, that all the cost that's been incurred to make that asset serviceable for the first time is called as initial cost. And we will have to keep on capitalizing it unless or until we have realized it now that it's usable, it's ready to use commercially. Okay. Once it has arrived at the shipping port or at airport, what next? To bring that to your country or to enter that into your country, you have to pay what? Taxes, duties. These duties are non-refundable, custom duties. To clear it and entry to your country, it requires to have the duties to be paid. These duties are never refundable and will be topped up in it. Since you don't pay a duty, the custom will never clear it. And you will never be able to get that plant into your hand, which one day you expect to bring that into use. So all is a part of one day my asset will become serviceable. So it will take custom duties, excise duties, port taxes. It can also take value-added tax. But value-added tax at times refundable to registered businesses. So you pay it upfront and then later you actually refund it back. So it's not a cost to you. But even if a VAT is not refundable, will also be topped up into it. Finally, the asset has arrived into your country because it has been cleared by the authority. What next? You will have to deliver it to your own premises. So that delivery and transportation and handling cost will be another cost you will incur, which will bring your plant from shipping port to your premises. Understanding it or not? So all of these costs are incurring on the way to make that asset serviceable one day. But it's still not yet serviceable. Now it has arrived at your premises. What next? You will have to prepare a site for it. It's not a small asset. It's suppose it's a textile mill, it's a textile unit, or it's a sugar mill unit. So you will have to first of all prepare a site for it where you have to fix it in. So preparing the site again is a part of bringing that asset serviceable for the first time. It's still not been usable. So on the way to prepare the site, now after you have to come and install it. Installation costs. So all of these costs are written there, by the way. I'm trying to reveal them up gradually. Same sequence by installation cost you will incur. Now, during the installation, at times it happens that you have to hire an expert, a professional person, a technician or engineer who has to come and help you in installing, because you cannot install it. You don't have an expertise. So you have to hire an engineer, an architect, a technician who has to come and install that plant for you. So you will pay what? A professional charge. So professional fee can be added into it. Now, once the plant has been installed, what next? Test runs cost. You can't be using it live unless or until you are testing it first. So test runs cost will be the next cost you will incur. So in the test runs cost, maybe you will put this plant on a test for a week, within which the overheads cost will be incurred, labor cost will be incurred, materials cost will be incurred. So for about a week, you have been able to put that plant on a test. Still not usable. And finally, once the tests are satisfactory, then you will be able to use that as from tomorrow for commercial reasons. So all of these costs that has been incurred up till now will be capitalized, and that is what we are calling it as initial cost. First time you are incurring such cost to bring that asset usable for the first time, that cost is called as initial cost. And how easy is that to remember if you can actually stretch the whole example of this kind in your mind up there. It's a chain of events, and you can easily remember it by going from one event to next, and then next to next, and then next to next. You don't have to grab it. Okay, there are certain other costs which can be incurred. For example, own labor cost. If your own labor is there to install the plant, if your own labor is there to construct your plant, then own labor cost will even be capitalized. Own labor cost means salaries, wages. These are the costs that usually we expense, don't we? But in the case, if your staff is involved in constructing your asset, installing your asset, then the salaries and the wages will rather be capitalized. If the asset is self-constructed, or if it was self-installed, so whatever the cost being incurred during the course of construction, during the course of installation, will rather be capitalized, will not be expensed out. There's another thing that you probably are watching, the borrowing cost, the interest cost, in simple word, the finance cost. Occasionally, when an entity borrows the money from the bank and use that money to acquire a plant, then the interest cost that they incur on this borrowing can be capitalized. But for this reason, we will have to take an help of IAS 23. It is that kind of a topic where you will come to learn the borrowing cost, when and how will be capitalized. We never have capitalized the borrowing cost in the life. But ask this to yourself. Have you ever capitalized the borrowing cost? You'd always have been treating the interest cost in profit and loss by expensing it as a finance cost. Never in the life you have capitalized the interest cost. But you will come to learn this in the standard IAS 23 the next week. That occasionally interest cost can be capitalized if and only if the criteria, conditions are satisfied, and we will come to look into those conditions the next week in topic IAS 23. So IAS 16 just has made the reference. Look, the borrowing cost can be capitalized, but make sure that you go and take the help of IAS 23 first. So I have been able to also refer that if allowed by IAS 23, then it will be capitalized. Otherwise, it cannot be. So we will come to learn this into our next course, that in which situation and how the interest will be capitalized. And then comes the future site dismantling and restoration. What is dismantling? If I have to explain this word easy to all of you, it's as if you install an application in your cell phone, and if you do not like it, you come to what? Uninstall it. That uninstallation is what? Dismantling. First, you have installed the plant. Today, after 5 years, once the life of this plant is over, what you will do? You will come to uninstall it and throw it away. That is called as dismantling. The word future is used for the reason why, because this dismantling thing will happen after 5-10 years, not today. Similarly, restoration is what? Today, the site has been prepared. After 5 years, once the plant will be removed, dismantled, you will have to bring that site to its original state as it was before. So that is called as restoration or cleanup task, site cleanup. You're cleaning up the site as it was originally before installing the plant, so that you can do something else afterwards on that. So both of these costs, because are expecting to incur in the future, so the word future is attached to it, and correspondingly they result into a provision. So we will come to look into our provision topic on this more in detail in chapter 13. I can refer. We will look into chapter number 13 on provisions, because this cost is expecting to be incurred in next years, So it results into a provision balance. And we will come to look into this talk of this dismantling and restoration cost more in chapter 13 under the banner of IAS 37 provision topic. So it's easy when you go and try to learn this paper, else you will try to cram it. And when the cramming comes into the play, problem will arise because you will forget it about after a few days, and maybe on the day of exam in a panic situation, in a lots of the pressures going on the day of exam, you will start forgetting it. If you will have this good example of taking and going event by event, that this event, next event, next event, next event, you will never be able to forget. Okay. Abnormal wastages or errors rectification are not capitalized, they must be expensed out. And I can tell you the reason why. The reason is unplanned, unforeseen. Can you plan an error? Error is something that's not planned. So during the course of construction or during the course of installation, there has been an error on site, which now you have to what? Fix it, which is called as rectification cost. This cost is never planned. It's never foreseen, but it just has incurred exceptionally and does not incur every time. Every time you come to install the plant, you do it smoothly, but occasionally it can happen. Exceptionally, it has happened this time around. Usually do not incur. It is an unplanned cost, or it is one-off event which does not take place every time. You do not commit an error each time and incur this cost. Out of the 10 installations you have done, maybe once or twice it has happened, which was not even expected. So getting the idea why it's not usually the cost that you incur while installing the plant or constructing the plant, it just has exceptionally incurred. That is the reason why it cannot be capitalized, rather will be expensed out. Because it's not a genuine cost of installation. It's not a genuine cost of construction. It's exceptional. And abnormal losses are also exceptional. Abnormal loss is the one what is more than to what you had planned. During the course of construction, you had planned that this much of loss you would have to bear it. But if the loss was there more than to that what you've expected, it's called as abnormal loss. Over and above to what you thought. So it will even be expensed out. Keep that in mind. And also the reason of that why it will be expensed. Unplanned, unforeseen. To revise this whole talk, we have one question, and I will take you to that. These questions are topic specific. These questions are not exam level questions. These questions are topic specific. We finish whatever the part of a topic, and to revise this, we immediately come down to perform. As you can see, this question requires us to focus on what? Just this thing. Well, that's what we have learned so far. Calculate at what amount, calculate the amount at which the initial cost of the plant should be measured. That's what we have just finished, haven't we? So these questions are not exam level type questions. These questions will enable us to take a bit of a pause and revise what we have done so far in a way of question before moving forward. These questions are called as learning examples, numbered as 5.15 means it's a chapter 5 that we are in, and 0.1 is it's the first application of chapter 5, 5.1. I will be solving all of them on the whiteboard explanation. But still, the solutions of these learning examples are there at the end of the chapter. But still, I will be solving and explaining. So starting myself off with the learning example 5.1, which is just about finding the initial cost. The product has recently purchased an item of plant for plant co. There has been the plant purchased. And the details are provided. Starts off with the list price. This is the list price, which is the price that being the buyer, I will be required to pay. Trade discount. And this will reduce the price by 12.5 instantly. Or in other words, you can say, I will end up paying 87.5. If I was supposed to pay $100, so I will end up paying what? Minus 12.5, 87.5. The price will reduce down to 87.5 instantly. Additional cost in salary cost means additional cost, a shipping and handling cost. These are all the costs that we have talked about. So we will not go to talk much about now. We would rather go to solve it. Shipping and handling cost, pre-production testing, maintenance. Oh, maintenance cost is something that we have not yet talked about. So what to do with that, we will come to look into it in a while. So I've been able to put a question mark next to it. Site preparation, in which we have cable installation, concrete enforcement, own labor cost. Product paid for the plant within the 4 weeks of the order, thereby obtaining an early settlement discount. Now, this question says that they have obtained a discount, but how many weeks after? That is what I was talking about, that the settlement discount is availed several days, several weeks, several months after the date of order. So even if the question says that it has been availed, no chance of incorporating that while computing the cost on the date of order list. So where will this be treated? You will get to see me explaining in some time. Product had incorrect specified. Now this incorrect specification looks to me a mistake, which obviously if they were aware of, they would have never done that. But mistakes, errors are never planned. They just happen. The cost of correcting this error is 6,000. And this is that cost that I was talking about, that this cost was never in budgets, because this cost does not usually incur. Exceptionally, they had to incur this cost to fix this problem. And they say that this figure is included in the above figure of 14,000. So let's go to write it. This 14,000 includes 6,000 from the rectification cost. Or in other words, can I say that if this cost was not incurred, the genuine cost of cable installation would have been by 8,000, which is genuine, normal, foreseen cost, budgeted, planned cost. But because this time they had to incur this extra, so total is 14,000. Plant is expected to last for 10 years. That is a useful life. At the end of this period, there'll be a compulsory cost of 15,000 to dismantle the plant, 3,000 to restore. So that is it. Just go and make the list of that so that we can complete this up before moving on to the next thing. Starting myself off with the list price, 240,000. This will be reduced by the effect of trade discount, which is 10%. Sorry, 12.5%. So 12.5% of 240,000. That is 30,000. Next up is the shipping cost. We'll definitely come and top this up in shipping cost. The figure of the shipping cost is given as 2750. And comes the test runs cost, or I can write it as testing cost. That one is given as 12500. And finally, the thing that has come to our way, which we so far have not talked about, and now I'll take this moment to talk about. Are we going to capitalize the cost of maintenance? Your prior accounting concept suggests that we will not, because maintenance and repair costs are always expensed. Yeah, we will not. But now you will come to see me explaining the reason of why it cannot be capitalized and rather expensed. So get ready to listen to why not the maintenance cost is capitalized and will rather be expensed. First of all, maintenance cost is an example of subsequent cost. That is the reason why we have not taken this maintenance cost into our talk, because I did not so far focus on this. I was explaining to all of you the initial cost, whereas subsequent cost we had yet to discuss, which takes the maintenance cost. So we can take this moment to even cover this side now. We can take this moment to even cover the side of subsequent cost, because maintenance cost is not an initial thing. You buy an asset first time, you don't start incurring the cost of repair and maintenance on the first day. Suppose you buy a car from the showroom, brand new. Will this require to have any repair and maintenance on the day you have taken the car out of showroom? Or maybe your cell phone or a laptop. Take any example. Will you be incurring any sort of repair and maintenance cost on the day you have acquired an asset newly? Never. It will be a part of that later in the life. So subsequent cost. The subsequent cost at times can be capitalized, at times it can be expensed. It all depends on the criteria. If the criteria is satisfied, the cost will be capitalized. And if the criteria is not satisfied, it will be expensed. So what is the criteria then? Let's pay attention to. Criteria, very simple to understand. The criteria says that if by incurring the cost, it adds value to a business. You have incurred the cost subsequently, and with that, the value has been added to the business. It has brought extra to business, something extra added to business. And that can happen in many ways. Suppose the quality of output has been improved. You have incurred the cost subsequently in such a way that the quality of output has been improved. Quality of a product has been improved. Now, as a result of the quality of the product has gone up, you will have the chance to increase the price of product. Happens or not? Good quality item is sold expensive and customer pays for that, because customer does not mind paying extra for an item which is of a high quality. So now when you have incurred the cost, and as a result of that cost incurrence, the product of your item, the quality of your item has been improved significantly. In return, you will be able to increase the sale price of that item, which ultimately will bring what? Extra. The same product now will start bringing extra towards the business. Margin will increase. So this is an example that you must have to think of, that, okay, if the cost is incurred, as a result of that, the quality of output has been improved. The business will be able to charge more price for that. And with that more price, they definitely will make more out of it, more profit out of it. Value can be added by other ways also. Another way of adding the value is to have an extension of a life of an asset. Suppose the machine that you have is only left up with 2 years to run. Originally, 2 years to run. That means this machine can expect to give you the further 2 years of benefit. But now you have been able to install a component in based on to it. The life of the machine has been extended to 5 years. Which means what? This machine now can recover you the benefit of 5 years, which was originally 2. So 3 years of extra benefit is a value addition to a business. So by extending the useful life of an asset, the value can also be added. And third possibility is that may have increased the overall earning capability of the business. And I can give you an example for that also. A 2-story building, originally the business has 2-story building. Now they've been able to construct further 2 stories. It's a 4-story building now. They can do the double. What they have been doing that in 2-story building, now they can do the double in 4 stories. Earning capability has been increased. All of these examples that I have given to you, they definitely will bring extra to business, improving the quality of output, extending the life of an asset, or overall earning capability has been increased. All of these examples, they will contribute extra to business. Therefore, in that case, the cost will be capitalized. But if the incurrence of the cost is just for the reason of maintenance, that will maintain the earning capability of the business, will not bring extra. And I can give you that example. The same two-story building now has been repainted. It has been repainted today. So repainting cost is subsequent cost. But that repainting cannot bring any extra to business, because that painting will not bring anything extra to business, since the capacity the business building has will be the same capacity the building will have after repainting. It's a two-story building at the end of the day. Only the life of the building will be maintained with that by putting a repainting, but never will add extra to business. That's the reason why always in the life, the repair and maintenance cost has been kept expensed out. And enhancements, improvements, extensions are capitalized. This is the criteria that runs in the background, that probably for the first time, you have been able to learn it. Before then, you had been keeping it into your mind, okay, repair and maintenance to expense, enhancement to capitalize. But now today, you probably have been able to learn the proper logic behind. And that's all written over here. Increased production capacity, extending the life of an asset, quality of output. By any way, if the cost that you have incurred brings extra to business, should be capitalized. If not, expense it out. So maintenance cost in that context cannot be capitalized, because maintenance cost will not bring anything extra to business. It will rather maintain the same existing original level. Convinced? So by taking a time out, we already have been able to finish the subsequent cost on the way to finish initial cost. Do you see anything that is written on this page that's not been talked about, that's not been touched? Let's try to finish it off to complete the rest of the components. Cable installation. I remember there was a problem in cable installation, and that problem was some error. And we will have to remember the total cost of the installation was 14,000, out of which 6,000 was in relation to the rectification, which I will not be able to capitalize. The usual cost of installation will be capitalized, not that exception. I have taken that out. Then comes the concrete reinforcement. The figure for that is what? 4,500. And then comes what? Own labor cost. $7,500. So it's not just about making a list and finding the total. It's about knowing why to take this and why not to take this. This should be more of your concern right now. Next up is the future dismantling cost and future restoration cost. Both of those figures are given. We just have to take them as they are given. The one of the figure was 10,000. The other was 15,000 and 3,000. There you go. So this is the initial cost at which this plant will be capitalized in the financial statements at. And what is this? Let me bring my own calculator. Develop the habit of using the calculator. Do not do these computations on your cell phone, which is the bad habit of ours. Because you're not allowed to take your cell phones to your exam hall. So develop the habit of using the calculator. Although on-screen calculator will be provided, but I still advise you to take along your own calculator rather to. So this is the total I have got, which can even be wrong, and you can correct in case you have found some wrong addition subtraction I have done. But if it is not, and this is it. So much of effort, even in finding the one little thing, a cost, and we are done by. This is the cost that will be capitalized in the statement of financial position on the account of this plant. Now, what I can do, although they have not asked from the same question, we can try to find that portion of cost that rather will be expensed. The first thing that will be expensed is the maintenance cost. What was the maintenance cost? Let's go to check. The cost of maintenance was 24,000, but noticeably for how long the service contract was for? 3 years. So what will belong to this only year is 8,000. Yes, don't be expensing the whole 24,000 out. It will be a violation of accruals concept, matching concept when you are going to expense. So you will go to expense that year's expense. The total is 24,000 for a 3-year service period. So you just have to go and expense that out for that year's cost, which will be 8,000. Then comes the cost of rectification. It was 6,000, was it? Yeah. Rectification cost was 6,000. The same was excluded out of that list, and now we've been able to expense that out. The last thing we are going to take is the effect of settlement discount received, which will now act like a balance of income and will offset it against the expenses. And this is what I was talking about. That discount availed will be treated later on in profit and loss as an income discount received. What was the percentage of discount? 3%. And we will be taking a 3% of the value that is after trade discount. Should be 210,000. And multiplied with that will give us what? So this is the answer that I will be able to get. And this is that portion of expense which will rather be expensed in statement of profit and loss. Work with that. So although they haven't asked, but we've been able to by anyhow work, and pretty much ends up the talk of cost. And see how the way things are written back into lecture notes, if I have to show to all of you. See, that's how the way the discussion starts off with initial measurement, which says cost. And then the same list of costs that we've spent time on: purchase price, less trade discounts, but you have to ignore settlement discounts. The same transportation handling costs, non-refundable taxes, site preparation, installation costs, professional fees, own labor cost, borrowing cost, future dismantling, and site restoration. So once you're done with that, you will find it so easy to read your detailed lecture notes, as I'm trying to show to all of you on screen. Even if you are not reading, you're not missing it out anything, because you already have completed that with this way and with all of that detailed live course explanation, which is obviously becoming a part of the recording. And then the detailed discussion in regards to subsequent cost, that when you are allowed to capitalize the cost of subsequent, when all of these three things are satisfied, either of these three things: extension of the asset's useful life, increasing the production capacity, or improving the quality of output. Haven't we discussed this all about already? They say that a component that has been replaced or restored must be treated separately for the purpose of depreciation. So we still have to go and spend time on this thing, depreciation. So we will come to talk about this thing more later on. But every time you come to bring in a new component in as a replacement or as a restoration, it will be treated the purpose of depreciation separately. Even the major hog will be capitalized, and we come to depreciate them up according to whatever the life. Any subsequent expenditure must be expensed out, including repairs, in the period in which the costs were incurred. So we're pretty much done with the detailed discussion on the cost. Not to forget, cost is the first most component of cost model, which is what we are done with. Good with that. Now try to see if the same way you people have done things in the past on I-16. That much of detailed talk, that much of in-depth discussion. You're certainly learning a lot of things out from the same standard which you people even have done in the past. And that is this level. You have to learn this topic in financial reporting course. Let's take a break for 10 minutes. Upon the resumption of the course, we will straight away get into a talk of depreciation. Many things are still coming to our way. So stay tuned. Do not go anywhere. I will see you in about 10 minutes to resume the course. Okay, I'm back. Hoping you're also there with me in the continuation of the course of today. After completing our discussion on the cost, now let's dig into the depreciation. Again, the topic of depreciation is something that you people have got this feeling that you're pretty much have been aware of. But like I said, we will have to respect this topic, or the reason why that the way that these things are going to be tested at this level are different from the way these things used to be tested in the past. Depreciation is an application of matching concept. Is an application of matching concept. Depreciation is an application of matching concept. You can see that the definition is written there, but this is a bookish definition. We will not be getting into cramming of systematic allocation of depreciable amount over an useful life. Nothing you will make out of it if you will just try to cram it. Rather, you will have to decode it, try to understand that, the essence of it. Few terminologies have been used, which we can also look into. The depreciable amount, which takes the cost less the scrap value. You know the cost now from the previous talk, the detailed talk on the cost. While the residual value, also called as scrap value, is the ending value of an asset, the value that you expect to get upon the sale of an asset at the end of its useful life. It's called as scrap value. See, I expect this asset will be there with me for 10 next years. So after 10 years, when I will throw it away, I will be able to get $500 on. This $500 is what? The scrap value, the ending value of asset, which is just an expectation. The actual value can be different from what you are not today making an estimate of, just an estimate that at the end of its useful life, once the life of this asset will over and I will throw it away, I expect I will be able to get $500. That this expectation of an ending value of an asset is called as scrap value. So you can see the word expect over here, very important. End of the asset's useful life. Now, what is useful life? Again, expectation. I expect to use that asset, say, for 5 next years. So that expectation to me is the useful life. The asset can be used for 10 years. For example, you buy a car and you expect to use that car for only for 3 next years. So useful, what is useful to you is your expectation, 3 years. But the car can still run for 10 years. So actually, useful life can be different from the actual life or can be the same. Your expectation to use that car for 3 years is the useful life of an asset. So coming back to the point, matching concept. Matching concept, a concept that requires us to match the cost with benefits of the same period. Whatever the benefits that you have achieved, you must have to match up the cost that was incurred in bringing those benefits for that period. One thing that you may have sensed it so far, that asset brings the benefits to you in the future. So you invest into assets. You buy an asset today with the intention of what? Getting the benefits out of that from in the next years. See, I buy a machine today. Why? Because I want this machine to be used for the 5 next years and take benefits from. So this clarifies to all of you that the machine, which is an asset, brings benefit in future. So cost you incur today in buying a machine. Suppose if you have bought a machine today for 10,000, the cost is incurred today. So how can I match this cost with the benefits that the next 5 years will generate? Cost is incurred one-off. By purchasing an asset, say for $10,000, you have incurred the cost. But my objective is to match this cost with the benefit this asset will generate for the next 5 years. So how will I be able to match? Depreciation. What do we do in depreciation? You know that we spread the cost of an asset over the life with the aim of matching the cost with benefits. By spreading the cost, may you use the straight line method, may you use the reducing balance method. What do? You try to spread the cost over the life. You break a little portion of cost each year and expense that out to profit and loss, where the revenue is there in the form of benefits and ultimately matched up. This process, you do that not just for 1 year, but you do that for 5 years over the life of an asset, 10 next years over the life of an asset. So that mechanism is called as depreciation. This is the basic essence. You have to have it into your mind. This bookish definition, to cram it, will not do anything for you. Systematic allocation of depreciable amount over an asset useful life. Try to cram it for 10, 20 times. But again, it's useless if you do not understand the whole essence of the depreciation, that why do we record? What's the purpose do we achieve out of it? What we aim to achieve into it. If you do not know that, no point in cramming it out. But calculations, anyone can do that. Methods of depreciation, straight line, you know how to calculate it. We'll get into that eventually. But first thing is to understand what is the depreciation? Why do we record it? Why do we charge it? What do we achieve out of it? I've explained that to you. Idea is to match the cost with benefits. Cost is one-off. You incur it in first year, which now needs to be matched up with the benefits that you will expect to get in 5 next years. So how will I be matching the cost with those 5 years of next benefit? I will spread the cost over the life of 5, and ultimately in each year, the cost will be matched up with the revenue, the profit and loss each year has. That mechanism is called as depreciation. 2 methods. Plenty of methods, by the way, practically speaking, but 2 of them are testable in our course, so we will restrict our discussion to these 2 only. Other than straight line method, we have double declining method, we have sum of digit method, we have machine hour method, and plenty more. 2 of them are testable. Let's just stick to these 2. What are the assumptions these 2 methods are based upon? Straight line method assumes that the asset provides the same benefit throughout. Means it takes an assumption that asset benefit each year. So that is the reason why, in order to match the cost with the benefit, I need to match the same cost each year over the life. Means you work the depreciation charge once and then you keep on expensing the same throughout. Because my assumption is that asset provides me with the same benefit throughout. So I am supposed to match the same cost over the life. So may you calculate the charge in the first year, may you calculate the charge of the depreciation in 3rd year, 5th year, 10th year, it will be a same figure each year. Because assumption is same benefit throughout. So I am supposed to match the cost, the same figure each year. This assumption works for buildings, because building is kind of an asset that tends to provide the same benefit throughout. But on the other side, the assumption of reducing balance is more realistic and is applicable to most of the assets, specifically like the IT equipments, machineries, motor cars, because these mechanical things, they tend to physically deteriorate. IT equipments tend to deteriorate, not physically, but technologically, technological obsolescence. You can understand what I'm talking about, how rapidly the technology changes. Each new year, the new model of the cell phone comes, the new model of that laptop comes with more faster processor and functionalities, and the space that it can carry into, the quality of a camera, applications, how rapidly. So this method takes an assumption that when an asset is new, provides better benefit in comparison to when it becomes older, provides less benefit, which is very much logical. Take an example of a motor car that you have. When it was acquired new, providing a good mileage consumption, requiring to have less sort of repair and tuning and work. But now, if you compare the situation of your car now to the situation of that time, it does not provide you the same sort of mileage. And every little after requires to have some repair and maintenance. Why? Machine it is. Physical deterioration. With the life passes by, it gets older. Physical deterioration. As a result of that, not the same benefit that the asset will give it back to you in comparison to what it was giving when it was newer. That logic is applicable to any machinery. Laptop also. New when it is, so fast. Now takes a bit of a more time to boot. Takes a bit of a more time to start. Sometimes gets stuck also. Sometimes, and the battery, the biggest issue. Don't provide the same backup as it was when it was new. So this reducing balance assumption is more realistic. It says that when an asset is new, provides better benefit, more benefit in comparison to when it becomes older, provides less. So even to match the cost with benefit, we will have to follow the same pattern. In starting years of asset, we will have to record more charge. In later years, we will have to reduce. So the name of the method is reducing balance, that every next year we will step in, the depreciation charge will reduce. Depreciation charge will reduce because when the life of an asset will grow further, when the life of the asset will go past by, the benefit will fall, the charge will even have to fall. Reducing balance method. So these assumptions are important. Over and above to the computation stuff, it's better that we keep these things with us rather just to focus on the computation side of the topic and feel happy about that we know how to calculate. And finally, the wait that you all have been waiting for, the calculation. And you know that already. I can just come to revive that quickly. So in straight line method, we take the cost. And cost, we know that is a historic figure. So you calculate the charge in the first year, second, third, fourth, fifth, 10th, 20th year, the charge will be the same because cost is the same historic figure. Yeah, subtracting the residual value is the same talk we have had it before, that to make this value depreciable, one has to subtract the residual value if given. If not given, obviously the cost, the only thing we have to use. And if given, you don't take it, that is going to be a problem. So please look into that question somewhere if the question provides us with a scrap value so that you can make the use of that in order to get the right charge. Then you may have been provided with a useful life or a percentage. It actually is the same thing. Both of these things can be used interchangeably. I can give you an example. Suppose the life of the asset is 5 years. Suppose. And if I have to find what percentage of depreciation that this asset will have, I will have to say 20%. Why? Because 20% for 5 times will depreciate this asset fully. Mathematics, 20 multiplied by 5 times is what? 100. So both of these things can be used interchangeably. For example, if the percentage of depreciation is 4%, then what would be the life? 25 times I have to depreciate this asset by 4% for it to be fully depreciated. So that 25 times is in fact the 25-year life. 10-year life, 10%. 2%, 50-year life. So both of these things are workable. The answers will be same. Either of the two will be provided. Whatever is provided, take it. Key thing to remember that in straight line method, it is the cost that will be used to calculate the answers. It results into a same charge each year, no matter you stand into the first year of asset, 10th year of asset, 5th year of asset to calculate the charge. In contrast to it, in reducing balance method, we take net book value. Net book value is a result of cost of an asset less accumulated depreciation. Now, this is a pool of depreciation. It's a pool of depreciation. So each year when the depreciation is recognized, becomes a part of this pool, which results into what? Increase the balance of pool. And the balance of the pool increases, what goes down? Net book value. And when the percentage is based on that to net book amount, that charge even falls each year. So that's the whole science, that how come do we get the less answer each year? Because here we are not computing the charge based on the cost. Here we are computing the charge based on to a net book value, which equals to cost less accumulated depreciation. So every year when the depreciation is integrated in, the balance of pool of the depreciation increases, which effectively decreases the net book value. And ultimately the charge based on to that even reduces. That's the whole science. So to sum this up, we have a very simple, easy question. We can come to do that, just to revise that, and peacefully we can do that rather being too much hurried on. So the question requires us to do nothing except calculate the depreciation charge and the amounts to be included in the statement of financial position for the year ended 30th of September 2008. 30th of September 2008. Okay, so question provides us with the following are the figures extracted from the trial balance of Telenor. The question provides us with the cost and the respective depreciation. Right of use asset. Now, if obviously you're not aware of what is this right of use asset, we will get to know this thing in IFRS 16, chapter 8. Till then, you can just be assuming that is just any asset or leasehold asset, the asset that's been taken on lease, plant and equipment, and computer system. They're providing us with the cost of these three assets. This one being taken on lease. The other two of them are owned. The term right of use asset, if you cannot digest, leave it aside, because we will come to spend time onto that in IFRS 16, chapter 8. So till then, you just can call it as just an asset. The cost of that is this given, their respective depreciations. Telenor has the policy. Right of use asset, they have to depreciate it based on to the term of the lease. The term of the lease not given, I can be assuming it as 10 years. While plant and equipment, they want me to depreciate based on to that 5-year life, and the scrap value is also given. While computer system, 40% on reducing balance basis. This question is nothing except requires us to once again pass ourselves over to this computation stuff. Then they say that the depreciation of the leased asset and the plant, to treat that to be a part of cost of sales, while the depreciation of the system goes to admin cost. No big issue. Let's go to solve this question as quickly as we can, so that we can move ahead to learn plenty more things in relation to depreciation 5.2. So what I will do, I'll try to prepare 3 columns: leased property. The next up is plant. Yeah, third one is computer system. So I can write down their cost, existing whatever is given. The cost is given as 56250. We have 55,000 and 35,000. Alongside, they've provided us with accumulated depreciation. 18,12800. 9,600. Now I will go to find the depreciation for the year, and now I'll have to follow a policy of means the method that I have to go by for the lease plant, for the plant equipment, and for the computer system. For the lease property, they want me to depreciate based on to its lease term. So 5625, I will take it 5625 divided by a life. That should give me a charge of 5625. Then comes the plant and equipment, which is 5-year life and scrap value is given. So I will go with 55,000 minus 5,000 divided by 5. That should be 10,000. And then comes the last thing in it. That's the computer system. It's 35,000 minus 9,600. The 40% of it. 35,000 minus 9,600. 40% of that has to be 10160. 10160. So this is the pro forma that I have prepared, which will give you a bit of a glimpse of what we will do later on while we will prepare the financial statements onto a spreadsheet. So this pro forma was not just there to solve, or you can say calculate the figures, but also you can take an impression that this how the way when we will work on to financial statements later on, we will be preparing a working note of property, plant, and equipment, and lots of things will come in, valuations will come in, disposals will come in, but basic theme of preparing the pro forma for the property, plant, and equipment while working onto a question of financial statements will be of this kind. And it's so easy to prepare on spreadsheet. It takes more time to do that on paper. So easy to do that onto a spreadsheet. So 56250 minus 18,000 minus 5,625. That's going to be 3265. 3265. This is 55,000 minus 12800 minus 10,000. It's going to be 32200. Then we have 35,000. We have 9,600. We have 10160. So there you go. This question was $10,000 in the second column. Yeah, I already have done that before you have to write it. Before you have to say it. Okay. Then they want me to recognize the depreciation being the part of cost of sales. There are two functions of cost. This is cost of sales, and this is admin cost. So first two depreciations will go in the first column. And this is 56250 plus 10,000, 15625, 15625. 15625. Got it right. So this is something that we will do that later on when we'll go to prepare the financial statements, and the depreciation will be presented. We'll come to present that being the part of the cost of sales or admin cost. And this is how the question will come to tell us. And this is that working note, which later on onto a spreadsheet we will be preparing while working onto a question of financial statements. And above them all, we've been able to revise ourselves with these two basic formulas, and not leaving any loopholes aside. We will we can move forward. Rather, if I had bypassed this thing on the assumption that you know this, may have been not the case. You probably been struggling to work the chart of the depreciation, which after to that, at least I will be confident that you have taken the whole explanation from my side, from my way, and you're prepared with. See, that's how the way things are written back into lecture notes. Starts off with the definition of depreciation. Then the methods, the two of them, straight line reducing, how to. We already have had a talk. And see, I was talking about that what is more feasible to these sorts of assets are reducing balance. Commencement. When do we have to commence the charge of the depreciation? When the asset is made available for use. Even if it has not been used, we will have to commence. When the asset has been made available for use, that is the day we will start recording the depreciation, even if it actually has not been used. That is what this first line on the top of this page says. On top of methods, there are some policies which we also have to respect, and they are impactful. If we will not respect the policy of the depreciation, no point that you will be able to get your right answer. So over and above to the methods of depreciation, it is so much important for us to understand the policies. So to understand this, what I can do, I can make something a simple example to work both the policies on it. Suppose this asset is purchased for $5,000 and it has a useful life of 10 years. Yes, this asset was purchased. The date of purchase I can mention and the date of disposal. When was that being acquired? It was acquired on 1st of July 2021, disposed when 30th of September 2024. So I have been able to write the date of purchase and the date of disposal. And the question that we are attempting, the company follows a calendar year, which means it starts on 1st of Jan, ends on 31st of December. That is the day it starts on. And that is the day it ends on, a calendar year. So if I have to go and follow the policy of months, called as monthly pro rata policy, at least we can find the charge for the depreciation on this page itself. So it will be the cost divided by the useful life. Should it be $500 a year? Yes. We will have to calculate the charge for all the concerned years, 2021 all the way down to 2024. The 31st of December 21, December 2022, 2023, 2024. So the question is, the policy says monthly policy, which means I have to record the charge into that year. For the exact number of months the asset was there in use. And in that year, it was in use for 6 months, July, August, September, October, November, December. Therefore, $500 will not be charged. I will be able to charge the 6 by 12 of that, which means $250 in that year will be charged. Exact number of months we have taken into, this will be 500, this will be 500. And now when in the year of disposal, we will come to apply the same logic. How many months this asset was being held out for before it was being disposed? Jan till September, 9 months. So this will make me to record the charge for 9 months. So that policy is called as the policy of months. As we come to record the charge for the exact number of months the asset was being there, held in the use, both in the year of acquisition and in the year of disposal. See, on top of methods, you also have seen me making an impact of policies. So it plays very crucial while you have to compute the final charge into that year, depending upon which policy do you follow. The question normally specifies which policy you have to go by. But if the question does not specify, the policy nowadays that we have to follow is the policy of months, which is more common. While there's a policy which is called as full in the year of acquisition and none in the year of disposal. So how this policy will bring a change to the figures? Full in the year of acquisition, none in the year of disposal. This is the year of acquisition. This is the year of disposal. So full in the year of acquisition means regardless of the fact, the months the asset was being carried out for, the months the asset being kept out for, we have to come and record full in the year of acquisition. Even though the asset was originally being kept for 6 months, but we still have been able to record the charge for the full 12 months. None in the year of disposal. Even if the asset in the year of disposal was being kept for 9 odd months, but we will have to take what? None. And we have. See, on top of methods, these policies, they play very important part. So over and above to you learn the methods, you have to respect these policies. And I also have been able to revise the two easy and quick manner. Anything that you see on that page that's been written and I've not been able to touch, completed that all. Detailed talk. After that, at least I as a lecturer will have a confidence that you as my student of FR have been able to pass through to it. I'm not needing to now rely on any your prior assumptions that you have done this topic in the past, so you are keeping a knowledge of that with you. You may have not, or you may have, but by this time you have entered into FR course, you may have forgotten. I will be at least confident that you are my student who has taken all of this talk and explanation of the depreciation today. And this has been able to bring you all to that one platform where we can start complexing the things as from the next week and onwards by taking ourselves down to the newish standards. The discussion in regards to depreciation is not yet ended, still continuing. See what's next, the depreciation of complex asset. Just the title is complex, nothing is complex. What is complex asset? Let's get to know that first. A complex asset is the big asset, usually a big asset, but more importantly, comprised of having various components. And to add with, each component has its own useful life. So it does not need to be necessarily a big thing. Main thing that you need to understand that asset will be comprised of having various components. And to add with, each component has its own useful life. That completes the definition of complex asset. Examples can be cruise ship. Example can be the aircraft, 777, Boeing, Airbus A380. How big they are in size. How big they are. And they have variety of components within them. Each component has its own useful life. So if I have to pick some broader components of aircraft, engine, the body, which is exterior, outer body, exterior, and interior, the cabins and seating capacities and all. So these are some 3 to 4 major components. There can be plenty more. And each component has its own useful life. The life of the engine usually is measured in terms of flying hours, not in terms of years. And the life of the body will be measured in terms of years, 10-year life. Interior can have a slightly bigger life because interior is interior. It's a cabin that is inside. So it may have a life slightly more than to exterior because exterior faces the whole consequence of weather, the outer environment, the air pressure, the weather conditions and all. In contrast to that, the interior cabins, they are the cabins where they're not exposed to all such harsh weather conditions and all. So they can have more life. Exterior can have a little less life. And engines' lives are usually measured in flying hours. So how are we supposed to depreciate an asset of that kind, which will have variety of components and each component has got its own useful life? The answer is very simple. Separately. Depreciate the engine separately, interior separately, exterior separately, according to their lives, and then in the end, consolidate the results. That's it. That is the discussion. Check this out. Complex asset is a one which is made up of various components. Moreover, each component has its own useful life. That is a definition of complex asset. Now, for the purpose of depreciation, has to treat each part separately. And this example will explain the whole idea, as I was telling you. K operates in a leisure industry, bought a pleasure boat on 1st of May. So it's a boat. The boat has been classified as complex asset. Why? Why have they classified this as complex asset? Because of these 4 components. And see, each component has got its own life. Structure, propeller, fitting and hardware, navigation system. These are the 4 parts of this one boat. And each part has got its own useful life. So this is the best example that you always can put in front to revise the complex asset. And see, separately, each component has been depreciated. Check this out. By using the life of the structure, they're depreciating the cost of structure. Propeller 10, 15, and 5. Once the answer is being achieved at each level, in the end, they've been able to combine. They've been able to combine. They've been able to combine. Okay with that? So there are certain things which will come to our way and they are easy to learn, although they are slightly newish one. Complex asset you never have learned in your life before. First time you have been able to see in the course of financial reporting. But it takes about 5 minutes to learn. And nothing is there further to invest time in. In the first place, you should need to know what is complex asset. Then secondly, okay, how do we have to depreciate for the purpose of depreciation? Easily you will be able to. So first thing first, what is complex asset? An asset comprised of having variety of components, with each component had got its own useful life, is called as complex asset. How to treat that for the purpose of depreciation? Treat that up separately, just the way they are treating it. 4 components. According to their lives, we have depreciated, and in the end, we've been able to combine the totals. Good with that? No problem. So not everything on the summary will be found. There are certain things that I will come to explain from the lecture note itself. But again, the part that we will finish, I will come to specifically show to all of you on screen that, okay, this part of the lecture notes writes this complex asset thing, and this is written. By the time the topic will finish, you will be confident, okay, I have been able to complete all of my detailed lecture notes also. I know which page has what and which question on. So you'll be pretty much confident about, you'll be having a strong grip over to your lecture notes and all. Since the start of the course, I have been able to show to all of you on the screen what's there back into your detailed lecture notes, where the concentration is on summaries a lot. Alongside, you also have been able to see me consistently bringing those lecture notes up front and trying to let you all know, okay, this is this written, this is where written. This gives you that extra kind of a confidence that we're covering everything. You have to develop the habit of reading the lecture notes. This habit to read the lecture notes and the study text will benefit you a lot in level 3. Because if you will develop this habit now, then it will carry forward to level 3, where a lot of reading is required, a lot of self-reading is required, a lot of article reading is required, a lot of book reading is required, a lot of past exam questions, answers reading is required. Which obviously at the level 2 is more of a spoon-feeding task. Whatever the lecturer has explained, practiced, your job is to just revise and practice a little extra over 2. That's kind of a level 2 kind of a preparation. But in level 3, a professional student has to learn, study a lot by himself or herself, not as level 2. So develop this habit of reading the lecture notes, which are not as detailed as the study texts are, but slightly more detailed than what these summaries they show. The summary is just nothing except tries to make the whole topic quicker and concise. But like I said, just being relying onto that summary, you cannot all alone expect to pass your exam. You must have to respect your lecture notes, every page of that, every question of it, every line of it. Just the way I am in the class, making a good use of every page of the lecture notes and trying to highlight it for you. Apply this to your revisions even. What next? Change in the depreciation estimates. Now, the depreciation is based on estimates. Depreciation is based on estimates. And I can prove that how. Remember, the scrap value is just an estimate of yours. Useful life is your expectation. Even the method that you're choosing, straight line method, I have to apply, reducing, I have to apply on the assumption this asset provides the same benefit throughout. This assumption will provide me the more benefit in earlier years in comparison to, this is all your assumption. Useful life is your estimation. Scrap value is your so ultimately, depreciation is based on estimates. So IAS 16 requires an entity to review these estimates at least at each year end once. Once a year, at year end, the entity has to review these estimates. And if they are changed, they have to start calculating the depreciation based on revised estimates, not based on previous estimates. When the revised estimates they have to come and apply, they must have to apply these estimates to the book value of the asset of that day, not the historic cost. Effect will be prospective. Prospective means you will have to calculate the charge of this year and all the next years according to the revised estimates. There is no need to update the depreciation charges of all the past years. The effect is not retrospective, because the logic is when the last year the depreciation was recognized, it was recognized according to the best estimates of that time. If those estimates today have changed, as from today and onwards, the charge should be based on, not you will have to try and adjust all of the years and years of charges in the past. According to the situation of that time, those estimates were best. Today, those have changed. So has to bring the change into the charge as from and onwards. That's the common sense. Fine. So whatever I have been able to explain, it's all being the part of this. Let's go to read it. First thing first. IAS 16 requires the residual value and the useful life of an asset to be reviewed at each financial year end, as I've said that to you, together with the method of depreciation. So these three things must have to be checked at each year end: method of depreciation, scrap value, useful life. If the residual value or the useful life has changed, then the charge should be based upon. The change in the estimate is to be applied to the book value of the asset of the day the change has been made on prospective basis. You cannot expect to apply that not to a historic cost. Book value of the day must be used to apply the revised estimates at, and it will be prospective. Retrospective adjustment will not be required. So before I had to read this, I already have been able to explain that to you. And now your life becomes so easy to just revise it by reading it, because you already know that this part of the paragraph has been explained to me and I already know what's written there. I just have to come and revisit it as a student. See, revising an estimate is not your task. It's a practicality. The question will provide us with the revised estimates. Our job is to make the use of these revised estimates to calculate the new depreciation charge. This will be our job. But revision into estimates, it's a practicality. We will never be asked to review those estimates and try to change them. This question on the top of the next page requires us to more or less do the same task. As you can see the requirement. What is the old and new depreciation charge? So Edingham has owned an asset for 5 years, depreciating the cost of 40,000 on a straight line basis over the life of 20 years. A company has conducted a review of its assets and now believes the assets to have a remaining life of 12 years. The scrap value at the end of the life is 4,500. So they have provided us with everything: remaining useful life, scrap value, life. Think that you need to analyze what is the total life? 20. If the total life is 20 and they say that 5 years have gone by, the remaining life is what? This is original remaining life. But now they expect this to be for 12. Now, this is what we call as change in estimate. 15 according to what the original estimates were, which now has been revised down to 12. So if I have to calculate the charge, I now will have to calculate my charge based onto that 12-year life, not onto 15. And I also have started expecting the scrap value, which was never been the case initially. So all of these revised estimates I have to bring into my computation, but when I will come to apply, I will have to come and apply these estimates to the carrying amount of the day the change has taken place on. And I can do that in front of all of you. This is an example. So if I'm going to work and answering the depreciation, the old one and the new one, the depreciation, the old one and the new one. Cost was 40,000, no scrap value, and the life was 20. So the old depreciation was 2,000. New. For this reason, I will have to make the use of newer estimates, which is scrap value 4,500, the life is 12. And there I have to work the carrying amount on the day the change has made onto. And they say that the change being taken place after 5 years. It means I will have to stand on to that day and work the carrying amount, and that will work this way. 2,000 has been the charge. See, the cost of asset is 40,000 minus 2,000 per annum multiplied by 5 years. The answer will become what? 30,000. See, this is 2,000 what they have been charging it in all those past 5 years, minus the cost equals to what? 30. This is the value in the books today, the asset in the books being carried at, and you have been able to apply the newer estimates with or revised estimates with this to calculate the charge based on, which is going to be what? So even I'm telling you, the students at this level, they make troubles on. They become so overconfident that ultimately, even the questions like that, they make troubles. I'm telling you based on my experience, I've seen the students that they become too overconfident that depreciation thing, oh, it's a piece of cake. I can do that. I do not even need to bother to learn it, whatever the lecturer is talking about. But when the same thing is tested, they make blunders over to it because of that overconfidence. So whatever is coming to your way, may it be something that you have seen in the life before, and you keep a little bit of prior knowledge of that with you, still respect it. If I am taking this into my course explanations, it has a reason for that. Everything has a reason. So making a change in the estimate will not be your task. The question will provide us with the revised estimates. Our job will be to apply. And when you come to apply this to the carrying amount of an asset on the day the change has been brought in, not the historic cost. How to find the carrying amount? Take the charge for a year, number of years been passed by minus the cost equals to this. And finally, we can say that we're over to this thing after spending quite a bit of a time on the depreciation also. We started off with the definition of depreciation, within which we came to learn the terminologies being involved. Then we came to learn the whole essence of depreciation. Then I came to explain to all of you the assumptions these two methods are based upon. And then finally, the computation. Then policies. After to that, complex assets depreciation, the definition of complex asset and the way to depreciate. And in the last, change into the depreciation estimates. Takes a lot of a time when you take the discussion in depth. If even I have to do this discussion half-heartedly, I can wrap up the same topic in 1 hour. But like I said, I'm not trying to leave any of the loophole now. No matter you keep the knowledge of that already, or you do not, or you never have done these things in the life before, or you have done it, but now you are feeling not confident about. I've been able to try and bring all of you at the same platform by having a detailed talk. And this in return has given me a confidence that you are my student, to whom I already explained all of that. Now, tomorrow, I expect you to help me in when I will go to ask the questions, because I know I have been able to prepare you for all of the aspects of this thing and this thing. Many next topics we have planned to do based on the discussion of today. I have to remind you that I already have said this thing before starting the topic. I have to remind you whatever is going on being the part of this course is not just this course. As from the next week and onwards, you will start tasting the flavor of it. If I have to tell you the model of cost that right now we are in discussion of, this model of cost, it's not just the model of cost. It's not the model of the cost that applies to I-16. This model of cost will come to our way in many next topics to come. So once this model has been understood, tomorrow, if it comes to us in next topic, I will not be discussing. I will just be bypassing. So once prepared, a benefit in all those topics to come. Once not being prepared, penalized in every topic, it will be tested. That's the importance of it. That's one example I have given to you. Same like the valuation model. Same like the discussion of the depreciation is not done today. Many next topics will come and you will come across to that depreciation of intangible assets, investment property, leased asset. This depreciation is not going to leave you aside. And let this course to go forward. Like I said to you, you will start tasting the flavor of that by your side, whatever I am talking about. What's next? Let's take ourselves back to the summary and see what's planned on to our next, a disposal. Before we head towards to the revaluation side, let's try and spend a bit of a time on to disposals. We can finish this off in the next 10 minutes. We can finish this off in the next 10 minutes. The sale of an asset is called as disposal. When an asset is disposed, it's taken out of business. So just the way it's physically been taken out of business, the figures in relation to that asset are also written off. The cost of an asset, the accumulated depreciation of an asset, and we come to work the gain or maybe a loss onto a disposal of it. If in the asset in the books being carried, say for 500, being sold out for 600, it has been sold out for 100 more than to what it was valued in the books for. So that is called as gain on disposal. Or if the same asset in the books being carried out for 500 being sold out for 350, it's been sold by 150 less to whatever the value in the books is being carried at, that is called as a loss. You may have a loss, you may have a gain, the profit loss will take. You may have a gain, you may have a loss, it goes to profit and loss. Recording a disposal is a three-step process, and this is what I can come to make you understand by making a very easy, simple example, which will end up the talk. Disposal of asset, which is a three-step process, accounting. So I go and maintain cost account on the first. Then I go to maintain the accumulate depreciation, and then I will go to maintain the disposal account. This is the cost account of an asset. This is an accumulated depreciation, and this is the disposal account. This is the value at which all the assets in the books were carried at 5,000. And this is the respective depreciation. An asset has been disposed, the cost of which was 1,000. So my aim is to eliminate that out of my financials. What will I be doing in the first place? I will try to credit the cost account and debit the disposal, so that the cost balance that will go into financials will be without the cost of disposed asset. It's been filtered out. It's been written off. This is the cost of an asset being disposed, so I have been able to exit it. So whatever the cost that will fit into financials will be without the cost of disposed asset. That is what I will do that for the depreciation. Suppose the respective depreciation of this plant was 200. So I will be able to debit the accumulated depreciation account and credit what? Disposal. Now this double entry is making it sure that the closing balance of accumulated depreciation that you have been able to write is not without the depreciation of the disposed asset. Both of those things being taken out of financials. The records that now will feature will be without the facts of this asset being disposed. This has enabled us to find the net book value of asset, which is 800. And I suppose if this asset being sold out for 900, I will have to debit the bank account, credit the disposal account. We might end up getting a gain, we might end up getting the loss. This shows the gain on disposal. As the disposal account takes the debit of 100, profit and loss correspondingly takes the credit, which is a gain. But if the balancing figure falls onto that side, that should be a loss. So that is this process. How many times you people have done this in the past in your prior courses and have been able to quickly sum up this? This side shows the gain on disposal. If the balancing figure falls onto the other side, that will show the loss on disposal. That is the first double entry. You come to debit the disposal account, credit the cost. In the next, you come down to debit the accumulated depreciation account, credit the disposal. And in the last, you come down to debit the bank account, disposal, the credit. And finding the gain and loss is just the balancing figure, which goes to profit and loss. So this disposal thing has got nothing further to learn. Whatever we had to, I have been able to quickly sum up. Idea was to write off the effects of the asset being disposed. May it be a cost of that asset, may it be an depreciation, which is what in the first place we have done. The net book value of an asset was 800 being sold out for 900. So we've been able to make the gain of 100 out of that, which the profit loss will take it. This side shows the gain, this side will show the loss. As the nature of the double entry suggests, you're debiting the disposal account, crediting it what? Profit and loss. So crediting the profit loss means the gain will be recognized. So this thing does not have any new thing to understand. So I took that moment to quickly cover it. And we're over to a little bit of a soft start of valuation we can take it today, but mainly we will have to invest time onto that the next week. Valuation model, as you can remember from our earlier talk, either they keep the asset at its cost or they may value it. So the valuation is in fact the process by which the historic values are transformed into its fair value. Historic values are transformed into its fair value or market value is called as a valuation. So it's a process by which the historic values are transformed into its market or fair value. That process is called as carrying out a valuation. As a result of it, we might end up getting a gain on valuation, or we might end up getting a loss. Suppose if in the asset, the book's being carried out for 100, and the fair value of the asset is 150. Yeah, if I was applying the cost model, I would have been fine with. Since I have opted to apply the valuation model, which means I will have to bring the market value of an asset into books. So this will require me to lift up this asset up to 150 by recording the 50 upward valuation, which is called as the gain on valuation or a loss or surplus. Similarly, if the same asset in the books being carried for 100, the market value of this asset shows 90. So to bring this value into the books, I will have to decrease it. That downward valuation is called as loss on valuation or deficit. So it's like computing the gain loss on to disposal, because there you're comparing the carrying value of an asset with the proceeds. Here you're comparing the carrying amount of an asset with the revalued amount. Process almost remains to be the same, that in both of these areas, you will have to compute the carrying amount of an asset in the first place, which will require to be compared with the proceeds to calculate the gain loss on to disposal, or revalued amount to calculate the gain loss on valuation. So the accounting entries for that, the presentation of that, and many things in regards to the valuations we have to learn. And this topic, like I said, could have not been finished today. I told you before starting. This topic still can take about an hour of discussion, or safely 1.5 hours, the half of the course of next week. Because once we finish the topic, we take ourselves into practice questions, objective test questions. So that can take also further 30 minutes. So an hour of explanation and 30 minutes of practice. All in all, I expect this topic will continue to take the half of the course of next week. That is the significance of this topic. And you probably have tasted the way that the courses I have been able to conduct, and see the way I make the use of the lecture notes alongside the summaries, and what is the stuff that I do onto a whiteboard work, all like a package. This way we complete the one topic, and you get exactly the copy of that into your hands in the PDFs, this whiteboard work. While these are those notes which you people have already been shared with in advance, lecture by lecture, but all ultimately being the part of this recording you even has to get. Such flexibility, such greater features with all that course comes in, and we still do not take the benefit out of this double benefit, triple benefit than those they are taking the classes by going on to the campuses. Then it actually kills the whole purpose of taking a distance learning course and being so comforted at. Especially once we leave the course, in between the discussion of one topic, which does not finish and continues to the next course, it requires you to come up into the next course with your own revision. Imagine the flow that we all are in right now, the momentum that we have gained it. Difficult to get back into after 6 days when the same topic will continue. Not a problem for me as a lecturer. I'm talking about from the student's perspective. And I'm giving you the tips for that. So to get back into a same momentum and the flow that you are in right now requires to have a revision just a day before the course is planned. And for revision, you do not have to open the recording of the course. You just have to put these documents in front and read them off. Check the solutions of these examples that I have done. Check the summary, whatever the parts of the summary. Just need to place them in front. 30 minutes might be take out of your life. And the benefits are bigger. You do not understand unless or until you will follow it. This habit, if you will develop it from the first course, it will take you to end the course with that habit and for many next exams to come. But if you will not develop it from the first, you, by the time will meet me into a second course, you will already develop those bad habits and will start making the mess of this course. Little effort of 30 minutes of revision, bigger reward. Ultimately, it's you have to follow it and apply it. I only can give you my tips in the guidelines and the tricks based on to which you can stay more in connected to the subject. You have to listen to it or not. That totally depends on your understanding of the need of time. The need of time is that you people have started the course, introduction done last week, course today we have started, first course is finished. We will have to start taking the care of these courses week after week, rather to pile it up. No benefit in piling it up. You will never find the time to retrieve this pile and will watch the recordings and all. The best time to do that is that week itself. One lecture, 6 days. If we cannot plan to look at back this lecture, we can never be able to open that old stuff after 2 months or 3 months of pile and will try to mark my words. This is your course, your FR course. You people have paid the tuition fees for with the idea of learning and passing and qualify one day. And ultimately, you do not come to understand your own responsibility of studying, revising, being connected. Then no one else in the world can actually counsel you on that if you yourself will not. So with this comes to the end of the course of today. I told you the availability for the recording time is at 24 hours. So you will get to see that recording coming to your way at maximum within 24 hours. Whatever we have done in the course of today in the recorded form on the portal will be made available to you within that 24-hour time frame mark. That concludes the course of today. Thanks to all of you for coming. Have a good rest. Have a good night. Thank you very much.